Hey everyone, in today's video I'm going to reveal my entire investment portfolio at 29 years old. I'll walk you through exactly how I'm investing, category by category, and share why I've chosen each asset class in my portfolio. We'll discuss topics such as growth, risk, diversification, investing timeline, and how I plan on rebalancing my portfolio moving forward. Quick disclaimer before we dive in. This video should not be considered financial advice. Please do not blindly just copy my investments. I'm just sharing my own personal investing strategy, which is built around my age, goals, and risk tolerance, but please invest at your own risk. So without further ado, here's a breakdown of my investment portfolio. 60.42% is in the S&P 500, 26.92% is in other US equity, 7.15% is in international equity, 4.46% is in US bonds, 0.72% is in a real estate investment trust or REIT, and 0.33% is in international bonds. Let's start with the biggest slice of my portfolio, the S&P 500. This makes up a little over 60% of my current investment assets. The S&P 500 is a stock market index that tracks the performance of the 500 largest publicly traded companies in the United States. It includes companies across various sectors such as technology, healthcare, finance, consumer goods, and energy. So instead of just investing in one company at a time, the S&P 500 allows investors to spread their money out across 500 different companies. This provides the benefits of diversification, which means even if some of the companies perform poorly, hopefully the others will pick up the slack. Historically, the S&P 500 has returned about 10% per year on average. Now in the short term, it can be pretty volatile. Big drops happen all the time. But my goal is to invest consistently, even when the market gets a little choppy. Now despite its past performance, the S&P 500 is not without its own risks. About a quarter of the index is concentrated in tech giants like Apple, Microsoft, Amazon, Google, and Nvidia. So while the S&P 500 is considered diversified, it definitely feels a little top-heavy. If regulations shift or AI turns out to be a bubble, it could drag down the entire index as a whole. But even with that concentration risk, I see US large cap stocks as the foundation of my portfolio. It's a simple, low-cost option and historically been one of the most reliable engines for long-term growth. The next biggest slice of my portfolio is other US equities. This makes up a little over a quarter of my other investments, and it includes a mix of single stocks, small cap funds, the NASDAQ, and a few dividend-focused index funds. For single stocks, I currently own stock in companies like SoFi, United Health, Apple, Microsoft, Google, JP Morgan, Nike, and Palantir. Small cap stocks are another piece in this category. Most of my exposure to small cap stocks come from index funds that track the Russell 2000. Then there's my exposure to the NASDAQ, which leans heavily towards tech. That's a double-edged sword. It could mean higher returns if innovation keeps driving markets forward, but it could also mean more exposure if we see another bubble or market correction. Finally, I've got dividend index funds as part of my other US equities. These tend to be in sectors like utilities, healthcare, and consumer staples. They haven't grown as much as tech recently, but they generate steady cash flows and pay out dividends, which could add a little stability and income to my portfolio. So overall, this category gives me a mix of growth, small cap, and income, while still keeping me within the US equity market. Although there's a lot of overlap between these holdings and the S&P 500, it provides me with a bit more diversification within the United States equity market. Next up, we have international equities. A little over 7% of my investments are in international equities, including emerging markets, developed markets, and even international small caps. The reason I keep this slice is pretty straightforward. The US isn't the only growth engine in the world. Europe, Asia, and emerging economies all have industries and strengths that add diversification to an investment portfolio. Having some international exposure means I'm not 100% tied to the US stock market. I will note that as a US citizen, investing in international equities doesn't have the same tax advantage as investing in US equities. Even so, I think it's worth having a slice in these companies overseas. If global growth shifts, or if the US dollar weakens, then foreign markets could end up outperforming over a given time period. Next up, we have US bonds. US bonds make up less than 5% of my investments. At 29 years old, I'm focused more on growth than income, so I don't want a big portion of my investments tied up in bonds. But with that being said, bonds still play an important role in any portfolio. They're generally lower risk and lower return compared to stocks, but they bring stability and lower volatility. In other words, they help smooth out the fluctuations of an investment portfolio. And that stability can be just as important for your investing behavior as it is for your returns. When stock markets crash, having bonds in the mix can soften the blow. That makes it easier to stay calm, stick to your plan, and avoid panic selling at a huge loss. For me, this small portion of bonds is just a cushion. As I get older, I plan to increase my percentage in bonds for added stability. Next up, we have a real estate income trust, or REIT. This is just a tiny slice of my portfolio, but it gives me some exposure to real estate without having to own property directly. REITs invest in things like apartments, warehouses, and shopping centers, and they usually pay out high dividends since they're required to return most of their income to shareholders. The risk of owning REITs mostly come down to the real estate market itself. Interest rates, occupancy levels, and even trends like remote work all play a factor into the real estate market. In the long term, I'd like to grow my real estate exposure either through purchasing more REITs or direct property ownership. But for now, this allocation in REITs is just a placeholder. And last but not least, 0.33% of my portfolio is in international bonds. Now, to be honest, I don't necessarily buy international bonds directly. This exposure just comes from an index fund I own, which is why it's such a tiny slice. So there we have it. That's a full breakdown of my investment portfolio at 29 years old. Going forward, I'm planning to keep adding new money into all these categories, just at slightly different rates. My main goal is to build up more exposure to small caps, international stocks, value funds, bonds, and real estate over time. If you found this video helpful, go ahead and hit that like button and subscribe to the channel. It really helps get this video out to more people. Thanks for watching, and I'll see you in the next one. Take care.